And on today's show, how life expectancy affects the settlement market. Part 3 of this week's series on life settlements with life settlement experts Erez Rotem and Alex Sorokin of Integrity Life Solutions, LLC. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Innsmark. Let's get down to business. Well, welcome to day 3, gentlemen.
Well, thank you, sir.
Appreciate it. Well, before we get into the Stoli market as it is, because, this is what's wrecking the perception of life settlements. Everybody thinks, well, Stoli's dead. Well, that means that life settlements are dead. But before we get into that, life expectancy, we talked about this the last 2 days. We've kind of touched on it. The reason I'm bringing this up to you now is if you have not seen Monday and Tuesday's show, I highly recommend that you go back out and watch those 2 shows first so that you can get a kind of an idea and watch this in chronology. It'll help your learning experience to really go a lot better. Now, when we're talking about this, because remember, we're looking at people that are having different life expectancies. And when we went into the Stoli market, we went into the life settlement market, in my mind, that's 2 different areas. And I think that's why these 2 have been together. And they have mixed it up, and so much so it's confused the market.
I think you're absolutely right. And you're a smart guy, Steve, and in your mind, they are separate. But smart people are confused because they have viewed, and smart advisors are confused because they have viewed historically Stoli as being the same market. And it is true that Stoli derives from the basic concepts of life settlements, and without the basic market concepts of life settlements, there couldn't be Stoli. But the fact, and here's another problem, Stoli was big. I mean, there were thousands of policies that were created under Stoli. My feeling is that some of those policies were legitimate. There was insurable interest in some of those policies. Some of those programs were legitimate, and some of those programs were approved by carriers. Some of them were illegitimate. I'm happy, to be rid of the Stoli issue because it clouded things, and carriers couldn't stand them. And finally, the carriers figured it out, and Stoli is gone. By the way, there's also, a good deal of regulation and statutes passed in reaction to the advent of the Stoli market. So regulation has also added to the demise of this area. But when that hubbub, of activity stopped, then everyone sort of like relaxed and said, oh, well, this market is dead. There's nothing going on here. And, at the same time, of course, the economy fell apart. So it is natural for people to think this market is dead. Stoli went away. The economy went down, less liquidity. But the fact of the matter is things have changed. And capital is entering this market in a big way, seeking a rate of return. And this is why it's a good time, because Stoli is gone. The regulations have stopped. There's no talk now really about regulations. I mean, most of the statutes have been passed. There's 43 or 45 states that are regulating this already. So this is the good time to take a look at settlements as an option.
Okay, so when I'm looking at the word, when you said this, the golden word that the carriers hate, which is the insurable interest, which is the whole argument on life settlements. I mean, this is where the regulation rubber meets the road. Insurable interest, I'm selling a life insurance settlement, or a life insurance contract to a settlement provider who is in turn now going to own the policy and get the death proceeds. Is that an issue?
No, it's not an issue, Steve. Insurable interest is an issue at the time of inception. So there is no issue here of insurable interest.
So the carrier doesn't care. If I'm hearing you correctly, then the carrier doesn't care. After it's been sold, insurable interest really isn't an argument any longer.
The carrier shouldn't care. I'm not in the minds of the carriers. I mean, who knows what they think. But frankly, they were, in my estimation, these carriers were very worried about Stoli, and as they should be. And they were worried about the magnitude of this market. They were talking about, $100 billion, $120 billion. This market is nowhere near that now, and there's plenty of room to grow, which is our point. But I don't think the carriers have bigger problems and bigger fish to fry right now than life settlements.
Erez, when you look at a life settlement today, and you're trying to look, and you're trolling the markets just like everyone else, and we're trying to find inventory, how do you get the word out that this differentiation has taken place? Stoli has nothing to do with what we're talking about any longer. This is life settlements. I see you out on LinkedIn. You're on several different LinkedIn groups. How are you making that differentiation? Because are they seeing this?
I don't think people are concerned about Stoli anymore. I think people realize that was part of the market that's gone and beyond us now. Life settlements are life settlements, and Stoli was Stoli.
When you're looking at a client, like we look at several cases where the client says, I don't need this policy any longer, whatever the purpose I wrote it for originally it doesn't exist any longer, and he's looking to shop that. Do you see yourself being able to give a pretty good idea what it's going to be at the front end for the guy to say, hey, should I even go forward?
Well, this is self-serving, but we also have a fund where we buy policies. So we have our model where we know how other funds price the policies because we have our own model, which we use to price the policies. So it's a little self-serving, but yes, it's easy for us. Once we know the life expectancy and we know what the costs are to maintain the policy, it's pretty easy for us to figure out what the market's gonna give.
We come back from the break. We're going to continue talking about life settlements. We're going to leave Stoli behind because it doesn't exist any longer, and talk how we can play on this market and actually look at your inventory as a possible potential for this fund. We'll be right back in 30 seconds. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the informed risk guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back to the second segment. I want to turn to you, Rez, because I want to hear the parameters. I mean, we have agents out there probably in shock, actually, that the settlement market is happening. Right. Stoli's done, and it never had anything to do with Stoli. And people are always out in our audience are saying, Steve, I'm looking at life expectancy for single premium immediate annuity payouts. I'm looking for life expectancy to see how long I'm going to have the maturity date on the life insurance. So everybody's conscious of this issue. Mm-hmm. When we talked about this Monday, we're trying to keep our parameters. We're thinking that providers are somewhere around 10 years. When I hand you a case, and let's say we have an in-force ledger. Right. We have the annual statement. Let's say we even have a little bit of the meds because the Part 2 is going to be embedded in the policy. Right. That'll give us an introduction. Right. Based on that and the carrier who wrote it and when it was written, a lot of the things that you can kind of see in that, can I get a kind of a cursory guesstimation of what this is going to be?
Like I said before in the previous segment, you should always consult your expert because they're going to know better than you. But if you look at somebody's medical records, if they're 70 and they have no medical issues or they only have heart issues, then really they're going to have a long life expectancy. Everybody has heart issues. The medical field has really figured out heart issues, and you can live a very long time with heart issues.
So cardio is not really a big play.
No. But if you have comorbidities, and comorbidities means that you have multiple medical issues, like you have heart issues, but you have diabetes, and your diabetes is uncontrolled, that would be a great case because that person's going to have a substandard life expectancy.
So if I had that information for you and I had it in my hand, I know the face amount, I know the premium, could I get an idea? I said, well, I think you might get an offer between this number and that number. Is that okay to say?
That's okay to say, except you have to manage your client's expectation because a lot of the reasons why these...
I'm just trying to manage the advisor's expectations, because he's the one that's bringing you the idea. So he says, is this the... Because I'd rather... And we do want to say, we're always going to look at the conservative side of this because we don't want to set expectations above and beyond, not only for the advisor, but especially for the client. But I'm just trying to get in the game so the guy doesn't say, I went through this whole process and I probably should have not even done it at the beginning. But I want you to make that call, Rez. I don't want my advisor to make that call.
Right. If they don't manage their clients, the case is never going to work. You have to set expectations and you have to be conservative. So
I was looking, this is some years back, on the 2008 Society of Actuaries VBT relative risk tables. That was kind of an update from the 2001 CSO. Right. And so people started looking at, and not that that's the Bible or anything, but it looked like the relative risk. It was pretty much, hey, we could kind of get in the game here. Now we're looking at new numbers. I'm looking at single premium immediate annuities, and I'm looking at the actuarial numbers that are coming on this, how much they're projecting out. Then I look at medically underwritten single premium immediate annuities, which kind of tells me this is age rated up. Kind of gives me a different twist than a table rating. So I looked at a client the other day that was surprisingly was a type 2 diabetes. And so I asked the carrier who is offering the lifetime annuity the client could not live, what is his age? He's really 70, but what is his actuarial age? And they came back and said it's 77. If I had an actuarial number of 77 off of 70 because of type 2 diabetes, I should look at your case.
Absolutely. That's a great way to look at cases that would fit. To look at if they'd be medically rated, if they would qualify for a medically rated annuity. If they would, then it probably would be a good case for us because we're looking for differences in the table ratings. So if you started with a standard and now you're a table 3, table 4, that would be a case I would qualify. So that's a great way to look for cases.
Yeah, I mean, when you think about it, in the old days, we kind of left this technology behind because we're always into table ratings or flat extras, permanent term, temporary. But now age-rated, when I look at the annuity market, it kind of tells me, it tips me off, oh, this could have a second play. And that's why I brought it up, because this is some of the areas where you as an advisor, you're out there already, you're already getting your inventory, you're looking at single premium annuities, you're looking at annuitization schedules and life insurance with cash value. We're looking at all this. And I think it's really something to say, hey, I need to examine the LE on this and see how they're approaching it. That's in the game. They just took 7 years off this guy's life. That becomes a qualified for what you're doing.
Absolutely. That's a great case.
Well, now I'm thinking as we had about a minute to go. Alex, I have my numbers in. I'm submitting inventory now. From the time that we have a completed file, in my mind, a completed file, in-force ledger, annual statement, full APS information, and the latest update. In fact, actually, sometimes I tell my client, I'd like you to go in and have another exam just to kind of make sure your APS has a full look at it. I have all this done now, complete file done. I'm handing it to you. What am I looking at? I know, and there's no rule of thumb here, but I'm trying to get somewhere in the game. From the day I hand you a full file to the day I get an offer is, what would you think from your fund point of view?
From our fund point of view, we might be able to do that in 1 or 2 days. Once what does it take? It's just an analysis. The analysis is the simple part. It is an IRR calculation, and you can do it, on an Excel sheet. You can use more sophisticated software. But am I right?
Steve, that's our fund, though. That's not the regular market.
Right. Now, the regular market keeps coming back to tell me it's going to be 120 days minimum, maybe 6 months.
Well, that's to close. I mean, to be fair to any funder, that's to close. You have all the information, really. Now, do people do it in a day or 2 days? No. But it shouldn't take more than a week. To close is
if you have a full file.
If you have a full file. It's, get the meds, that's the tough thing. Get some policy information, that may be a little bit tough. But once you have, it's just a matter of someone sitting down, getting the business people together, and making a decision. Then, where we as brokers run into trouble is the time that it takes from the offer and acceptance to documents, to getting them signed, and due diligence that is done extensively, often by other providers.
Well, that's all the time we have for today's show. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? You can view all our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.